Do you really know when the right time to not invest? Well, something is going to happen in the next few days that will dictate if buying a CD may or may not be the dumbest thing that you can do right now. Before we get started, though, as always, like, subscribe, share our channel. Let's make some painful profits together with your CFP Mario Payne. On these YouTube streets, I give information, but in real life, I'm a certified financial planner, managed over $250 million in assets, but here to help. But today, we're going to talk about why locking in the CD rate might be good, also might be the dumbest thing you can do as an investor right now. Y'all ready? Let's stay tuned. Let's get some painful profits together with this information, y'all. Lego. Yahoo Finance. Should you open a savings account or CD before the Fed's next meeting? This is the headline. And why is this headline out here? Well, my profiteers. July 31st, the Fed may or may not cut interest rates. Now, most people believe that he's going to signal, Jerome Powell that is, he's going to signal that they are going to lower interest rates in September. So when they lower interest rates, that means our CDs that are higher will go down in value. Not the ones we're locked in, but the ones we get going forward. So the thought process is I should get a CD now. Well, let's look at the interest rates when rates are up and when rates are down. And as we can see, Nerd Wallet, high yield CDs, past 5 years. Look at that. Before we had rates go down like crazy. Under the Trump era, into the Biden, looking at a 5-year CD at 0.78% back October 2020. What? COVID. But now look, as we see now, right, a 1-year CD. How is it that something that's 1 year at the peak was paying 5.28% when a 5-year CD was paying only 4%? That doesn't make sense, right? Typically, when something is longer, it has a higher interest rate. That's what you call an inverted yield curve. When something that is shorter in duration pays more than something that's longer in duration. That's when rates are high. And interest rates right now, my profiteers, they're high. We see a 1-year CD, spell Mario, right? Basically 5%. Now, a 5-year CD, right? 4%. 100 basis points different, right? So if I got $100,000 for 1 year, I'm getting $5,000. For 5 years, I'm getting $4,000 a year. So the smart thing would be is, okay, well, let me lock it in now because when interest rates go down, what's going to happen to CD rates? A 1-year CD won't be 5%. It might be closer to 3%. Or a 5-year CD won't be 4%. It'll be closer to maybe 2.5%. So let's lock in a CD right now. Let's lock in. From a risk standpoint, money that you don't want to have invested, yes, probably good to lock in because we know when rates go down, CD rates go down. And we can look in here and see. As we can see, when rates went down, right, 2.85% all the way down to 0.78. So it shows when rates go down, CD rates go down as well. We should lock it in, right? Lock it in. And yes, for 10, 20% of your assets, maybe 30 if you're conservative, locking in today is a good idea because I'd rather get 5% than 4% down the road, right? A 5-year CD, I'd rather get 4% today than maybe 2.5%, 3%, 3 months, 6 months from now because the Fed's probably going to start cutting rates in September. Banks know that, so they're lowering rates now as they are, right? I mean, really, 5-year CDs been going down since January this year. And then, of course, since January this year as well for a 1-year CD. But my profiteers, that might be the dumbest thing that we do. Short term, maybe not that dumb. But long term, 6 months, a year from now, might not be smart. And this is why, my profiteers, this is why. Look at here, look at here. The investment response to rate cuts. Which assets tend to perform better after rate cuts, right? When rate cuts are first announced, -10, up to 30%. Look at here, my profiteers. 1 quarter, so basically 3 months after the Fed cuts rates. And this is historic. This is for the last 80 years, right? Fed's been increasing and decreasing rates for a pretty long time. As we can see though, 25% growth for real estate. Now, since May, real estate has been going down. Why, my profiteers, does real estate go up? Well, when interest rates go down, guess what happens? Loans, interest rate wise, go down. That means more people are trying to buy a house. Supply and demand. When more people try to buy a house, then that means the value of our house goes up again. I believe home values will get back to where they were earlier this year. My opinion. When it comes to stocks, up 18%. When it comes to bonds, yes, bonds, my baby, TMF, aggressive, or TLT, which are long-term treasury bond funds, go up because long-term, it's more attractive to buy something that's longer term because the interest rates, when things go down, long-term bonds go up in value. So in 3 months, historically, would I want to get something that's 1%? Because remember, my profiteers, you forgot, right? That 1-year CD is paying us 5%. Y'all forgot? Roy Jones, y'all must have forgot. Let's go back to the whiteboard. In the words of Roy Jones, y'all must have forgot. A 1-year CD paying 5%. That means in 3 months, you're getting what, 1.5%? Who does that? Now, history has a strange way of repeating itself, and historic performance does not guarantee future performance. Gotta say that as a certified financial. Y'all can't see me? I'm just talking my head off. Now y'all can see me now. I'm just talking. Past performance does not guarantee future performance. Have to say that as a certified financial planner. But as we can see, locking in that 1-year CD with all our money, all our investment money, might be the dumbest thing that we do if things continue historically where when the Fed cuts, the market goes up. But it gets better than that, y'all. 6 months, 2 quarters later, 6 months later, right? Housing market goes down a little bit, right? Because yeah, people getting houses. Okay, we understand. Housing goes down. Look at the market, up 19.4%. $100,000 at $19,000. $100 CD that's paying 5% today. 1-year CD, $2,500. Yes, it's great to lock in that great interest rate, but 6 months? Huh. Now, of course, when we make a decision that we can't get out of, we justify. We're going to say, well, you can't beat 5%. 5% was very good, very attractive. I get that. But if we look from an investment standpoint, not the best idea. Again, some of your cash, 5, 10, 15, 20, maybe 30% if you're conservative, but let's not get in CDs right now thinking that we're locking in because the Fed's going to cut rates. Let's get this great rate. But again, it gets even better. 12 months after that, woof, 25% for real estate, 23.9% for stocks. Now, I'm not saying when the Fed cuts rates, probably they're going to cut it in September. I'm not saying September 2025, the market's going to be up 23%. But if it is, my profiteers, that's double the market average. Market average is about 11% a year. That's 24%. 24%. What's that with compounding interest though? Look at the charts. Remember, $100,000, right? At 24%. That is 24K. Remember though, with compounding interest, next year, I'm not making money on $100,000. I'm making money on $124,000. So let's say the next year I just get what the market makes. Let's just say 8%, right? 8% on $124,000. My profiteers, that's another $12,000, right? So now in 2 years I go from 124. Now I'm at 136. Wow. Think about a CD. A CD, simple interest, means that you're making money on the principal not on where it is at that date. So if we kind of just erase this, my profit, again at $100,000, right? 5%, we made $5,000. Well, next year that 5% is based on another 100,000, right? 5 and 5, that gets us $10,000, 10K, you guys. So not only we're missing out on the market appreciation, but we're making simple interest, not compounding interest. And the third thing, number 3, interest on our CDs are not capital gain, ordinary income. Ordinary income. I sound like buy it right now. Ordinary income. That means we do our taxes. We're taxed at that tax rate. With a 25%, 20% tax bracket, I made $10,000. I'm taxed at 25, 28%. It's an investment, and I sell it after a year. It is a capital gain, which means I pay 15% long-term capital gains. Now, Kamala gets reelected or elected. Who knows what's going to happen? I ain't playing politics. It is what it is. But right now, it's 15%. So that same $10,000, I'm not taxed at 28%, or $2,800 gets taken away. It's only $1,500. So very, very important why investing, in my opinion, not doing CDs is the way to go. So yes, my profiteers, buying a CD right now might be smart, but it might be the dumbest thing you can do if history repeats itself. Drop it. So yes, my profiteers, great advice, right? But comment below. What do you guys think? You're going to get into CD rates? You think CDs are a sham? You think you make more in the market? Do you think that the market's going to go up after the Fed cuts rates? Do you even think Jerome Powell's going to cut rates at all? He might be bluffing. We don't know. I know one thing, education is the key. Making great investment decisions set you up for the long haul. That's why CDs might not be a bad idea. But long term, if history repeats itself, might be the dumbest thing that we can do. Who knows though? That's why it's good to give information.
Making no money mistakes, make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes, make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Been check to check, you knowing it could be different, you knowing.